Here's the thing about free trading. Every single broker screams it like they discovered fire. 0 commissions on stocks, 0 commissions on ETFs. Pick anyone, they say. They're all the same now. Except I spent 18 months putting real money into all 3 of the big players. Charles Schwab, Fidelity, Vanguard. Actual cash, sitting in accounts, making real trades, calling customer service at 2 in the morning with fake emergencies just to see who'd answer. And what I found was that free trading is the greatest magic trick Wall Street ever pulled. Because while you're staring at the $0 commission, they're picking your pocket in ways that make the old $8.95 trade fee look like amateur hour. One of these 3 trusted names was costing me more in a single year through invisible fees than I would have paid in 2 decades of old school trading commissions. So which broker actually deserves your money? I'm going to show you exactly what happened when I stress tested these platforms with my own capital, why the conventional wisdom about brokers being commodities is dangerous, and which single platform emerged as the only one worth using for 99% of investors. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of your brokerage account like a hotel. You see the room rate advertised everywhere. That's the trading commission, $0. Looks amazing. But then you check in and realize the hotel makes its real money on everything else. The minibar water that costs $7. The Wi-Fi that should be free but isn't. The resort fee that appears nowhere in the advertising. The parking that somehow costs more than the room. Your broker is that hotel. And the minibar prices? That's where we need to start. There's this thing that happens with uninvested cash in your account. Money sitting there between trades, or cash you're holding for the next opportunity, or even just your checking account linked to the brokerage. It doesn't just sit there doing nothing. The broker automatically sweeps it somewhere to earn interest. The question is, who gets that interest? This is the single biggest silent wealth transfer in retail investing, and most people have no idea it's happening. I put $10,000 cash in each platform, just sitting there, not invested. For 3 months, I tracked what happened. At Vanguard, my cash got swept into their federal money market fund, yielding 5.28%. That's $528 a year if I kept that balance. At Fidelity, it went into their government money market fund at 4.97%, $497 annually. Both of these are basically paying me what cash is actually worth in the current interest rate environment, fair market rate. Then I checked my Schwab account, 0.45%. $45 a year on the same $10,000? I thought it was a typo. I called customer service. The rep explained very politely that my cash was in their bank sweep program, and that was the rate. I asked where the other 4.83% went. Long pause. She said Schwab keeps it. That's their business model. Now, you might be thinking, okay, but who keeps $10,000 in cash? Most people invest it immediately. Here's the problem with that thinking. First, the average brokerage account actually holds about 15% in cash at any given time, according to Vanguard's own research. People are waiting for opportunities, holding emergency reserves, or just haven't deployed everything. Second, if you're doing any kind of tax loss harvesting, portfolio rebalancing, or taking distributions in retirement, you're constantly cycling through cash positions. Third, and this is the kicker, a lot of investors link their regular checking account to their brokerage. Schwab actively markets themselves as a checking account replacement with ATM fee reimbursements worldwide. Sounds great until you realize they're paying you 0.45% on what's essentially your operating cash, while the big banks are paying 5% in high yield savings. Let me give you the actual math on a realistic scenario. You're a 50-year-old with $400,000 in your brokerage account. Conservative allocation means you're holding about $60,000 in cash and short-term bonds for stability. That's not unusual. That's textbook. At Vanguard's rate, that $60,000 earns $3,168 a year in interest. At Fidelity, $2,982. At Schwab, $270. The difference between Schwab and Vanguard is $2,898 annually, every single year. That's not a rounding error. That's a round-trip flight to Europe. That's a new MacBook. That's 3 months of groceries. And it's money that Schwab is simply keeping because they built their profit model on the assumption you won't notice or won't care. This isn't some new revelation. There was a guy I read about, an attorney in California, who had $800,000 sitting in a Schwab account while he was closing a business sale. It took him 4 months to deploy the capital. He earned about $1,400 in interest. If that same cash had been at Vanguard, he would have earned over $17,000. He literally left $15,600 on the table because he didn't understand what the cash sweep was doing. When he called Schwab to complain, they told him he could have manually moved it to a money market fund himself, which is technically true, but it's also a perfect example of how the default setting is designed to benefit them, not you. The game is to make you work to get a fair deal. Now, this gets really interesting when you look at the incentive structure. Schwab manages $2 trillion in client assets. Even if just 5% of that is sitting in cash at their bank sweep rate instead of a fair market rate, that's $100 billion. If they're capturing even a 3% spread on that, that's $3 billion a year in pure profit from the cash sweep alone. This isn't a side business. This is a massive profit center disguised as a convenient default setting. But maybe you're thinking, okay, the cash thing is bad, but Schwab must make up for it elsewhere. Maybe their platform is so good, it's worth the trade-off. So I tested that. I made 50 trades across all 3 platforms over 18 months. Mix of stocks, ETFs, some options. I tracked execution quality, platform usability, research tools, everything. Here's where it gets complicated. If you are in the top 1% of retail traders, someone running multi-leg option strategies or trading futures, Schwab has Think or Swim. That platform is genuinely the best in the business. It's professional-grade software that makes interactive brokers look approachable. On-demand backtesting, absurdly detailed technical analysis, more indicators than any human needs. For that specific person, Think or Swim is the reason to be at Schwab. Full stop. But here's the thing. That's not you. That's not me. That's not 99% of people watching this. The serious active traders already know about Think or Swim. They don't need me to tell them. For everyone else, for the person buying index funds and maybe trading individual stocks a few times a quarter, Think or Swim is like buying a Formula One car to commute to work. Technically impressive, completely impractical. For normal humans, Fidelity's web platform is the clear winner. It's clean, intuitive, fast. The research integration is phenomenal. Over 20 third-party providers, including Thomson Reuters, built right into the interface. I can pull up a stock, see analyst ratings, read recent news, check insider transactions, and execute a trade all on one screen without clicking through 17 menus. The workflow makes sense. It feels like it was designed by someone who actually uses it. Schwab's regular platform feels like a corporate IT department built it, which is probably exactly what happened. It works, but it fights you. Then there's Vanguard. Their platform looks like it was designed in 2006, and nobody's touched it since, because that's basically what happened. It's clunky, slow, and offers almost zero tools for active trading. But this is intentional. Vanguard's entire philosophy, inherited from Jack Bogle, is to make active trading annoying enough that you stop doing it. They want you to buy 3 index funds and never log in again. For a pure Boglehead, someone who's committed to passive investing and never plans to trade, this is actually a feature. The platform's limitations enforce discipline. For anyone else, it's maddening. But platform design is only half the story. The other half is what happens behind the scenes when you hit the buy button. This is where payment for order flow enters the picture, and most people have no idea what it means. When you place a trade, your broker can either send that order directly to an exchange like the New York Stock Exchange, or they can sell your order to a high-frequency trading firm like Citadel. That firm then executes your trade and pays the broker for the privilege. This is payment for order flow. The controversy is simple. When a broker accepts payment for order flow, there's a conflict of interest. Are they routing your order to get you the best price, or to get themselves the best payment? Schwab takes payment for order flow on stock and ETF trades. It's disclosed in their fee documents, but buried deep enough that nobody reads it. Fidelity and Vanguard do not accept payment for order flow on equities. Their routing is designed with one goal: get the customer the best execution price. Period. No conflict. No question about whose interests come first. Now, to be fair, the actual execution quality difference is often tiny, a few pennies per share on average. On a normal trade, you might be talking about 50 cents to $2. Not nothing, but not catastrophic. The problem is the principle. Schwab is getting paid to route your order a certain way, and that payment is coming from someone who profits by being on the other side of your trade. It's a subtle misalignment, but it's there. And when you combine it with a cash sweep issue, a pattern starts to emerge. Schwab's business model is optimized for Schwab's profit, not your outcome. I ran a specific test. I bought the same ETF at the same time across all three platforms. $5,000 into VTI, Vanguard's total stock market ETF. I watched the execution price. Fidelity got me the best fill by 4 cents per share. Schwab was 3 cents worse. Vanguard was 2 cents worse than Fidelity, but still better than Schwab. On $5,000, that's about a $2 difference. Rounding error on one trade. But if you're making 30 trades a year, every year, for 20 years, those pennies compound into real money. The next layer is what you can actually buy on these platforms. This is where personal priorities matter. If you want to buy fractional shares, Fidelity wins by a mile. They offer fractional trading on over 7,000 stocks and ETFs. You can invest exactly $100 into Amazon or Google without worrying about share price. It's perfect for dollar cost averaging or building a diversified portfolio with limited capital. Schwab technically offers fractional shares, but only for S&P 500 companies. Vanguard only allows fractional shares on their own ETFs, which is basically useless for anyone trying to build a diversified stock portfolio. International access is similar. Both Schwab and Fidelity let you buy foreign stocks directly on international exchanges. Want to own Toyota shares on the Tokyo Exchange? You can do it. Vanguard doesn't allow direct international stock purchases. You're limited to US-listed funds that hold foreign companies. For most people, this doesn't matter. But if you want that level of control, Vanguard isn't an option. The biggest philosophical divide is cryptocurrency. Fidelity has embraced it. You can trade and hold Bitcoin and Ethereum directly in your brokerage account. Schwab allows exposure through Bitcoin ETFs, but not direct crypto ownership. Vanguard is actively hostile. They not only refuse to offer crypto, they actually blocked customers from buying spot Bitcoin ETFs when those launched. Their stated reason is that crypto is speculative and contradicts their long-term investment philosophy. You can agree or disagree with that stance, but either way, it's a direct limitation on your investment choices. If you want any crypto exposure, Vanguard is off the table. Here's where I need to address something. A lot of people think brokerage, customer service doesn't matter because how often do you really need it? That's the wrong question. The right question is when you do need it. How catastrophic is it if they fail? Because you don't call customer service to chat. You call because something is broken or money is missing, or you're trying to execute a time-sensitive rollover, or you need to settle an estate. These are high-stakes situations. Fidelity has the best customer service in the industry, and it's not close. 24/7 phone and live chat with US-based reps who are actually empowered to solve problems. I tested this by calling at 11:30 p.m. on a Saturday with a fake question about a tax form. Someone answered in under 2 minutes, knew exactly what I was asking about, and walked me through it. Then I tried the same test with Vanguard. I waited on hold for 43 minutes before someone picked up, and this was during business hours on a Tuesday. Their support hours are limited, there's no branch network, and the reps sound like they're reading from a script written by a legal team. Schwab is in the middle. They have good customer service infrastructure, lots of branches, generally competent reps. But ever since they absorbed TD Ameritrade, the quality has noticeably declined. Longer wait times, more frequent escalations, and a lot of former TD Ameritrade customers are furious about features that disappeared in the merger. Schwab bit off more than they could chew with that integration, and customers are paying the price in degraded service. There's a story I heard from a guy who was rolling over a 401k from his old employer into his IRA. 6 figures, time sensitive because of tax deadlines. He was with Vanguard. The process took 11 weeks. 11 weeks of back and forth, lost paperwork, and reps telling him it was being escalated. By the time it finally cleared, he'd missed the deadline for recharacterization and ended up with a tax headache. Same rollover at Fidelity typically takes 7 to 10 business days. When the stakes are high, customer service quality isn't a nice to have. It's existential. Now let me pull all of this together with a real scenario. You're 45 years old. You've accumulated $350,000 across retirement accounts and taxable brokerage. You're contributing another $2,000 a month. You want to retire at 60 with about $2.5 million, assuming 7% average returns. You're invested in a mix of index funds and a few individual stocks. You rebalance quarterly. You hold about 10% cash for opportunities and stability. Where should your money be? If you're at Schwab, you're losing about $3,000 a year on the cash drag alone based on the current rate environment. Over the next 15 years until retirement, that's $45,000 if rates stay flat, and potentially more if rates rise and Schwab keeps their sweep artificially low. You're also paying a subtle execution cost on payment for order flow that probably adds another few $100s a year in aggregate. And if you ever need help with something complex, you're dealing with degraded post-merger customer service. The only way Schwab makes sense is if you're using thinkorswim at a professional level. If you're not, you're subsidizing active traders with your cash. If you're at Vanguard, you're getting a fair shake on cash. But you're dealing with a platform that makes every interaction painful and customer service that borders on contempt for your time. If you have any interest in fractional shares, international stocks, or crypto exposure, you're out of luck. Vanguard works if you buy 4 index funds, set up automatic contributions, and never log in. That's the Boglehead dream. But if you want any flexibility or hand-holding, you're going to hate it. At Fidelity, you're getting everything. Fair cash rates that respect your capital, a platform that's powerful but actually usable, industry-leading customer service when things go wrong, the broadest product shelf including fractional shares and crypto, no payment for order flow and equities. It's not perfect. Their Active Trader Pro desktop software is clunky and feels dated. But for web-based trading and long-term account management, it has no deal-breaking weaknesses. The pattern here is incentive alignment. Vanguard is structurally aligned with passive investors because they're owned by their funds, which are owned by investors. It's a mutual structure. Their incentive is to keep costs low and discourage trading. Schwab is a public corporation optimizing for profit. Their incentive is to extract maximum revenue per client without losing too many clients. They thread that needle by offering premium tools to keep the profitable traders while quietly taxing everyone else through cash sweep and payment for order flow. Fidelity sits somewhere in between. They're private, family controlled, and have consistently chosen to compete on customer experience rather than pure cost. They make money, but they do it by being genuinely good at what they do, rather than playing psychological tricks with default settings. Here's what this means practically. If you are a committed passive index investor who will never call customer service and never wants to trade anything beyond basic ETFs, Vanguard is fine. Deal with the terrible platform and accept that you're getting the absolute lowest cost on the funds themselves. If you're a sophisticated options trader who needs professional grade tools and is willing to manually manage cash to avoid the sweep penalty, Schwab's thinkorswim is worth it. For literally everyone else, the answer is Fidelity. It's the only platform that doesn't force you to make a painful compromise. 3 takeaways. 1, check your cash sweep rate right now. Log into your brokerage, find the default sweep vehicle, and look up its current yield. If it's below 4% in this rate environment, you're being robbed. Either manually move that cash to a money market fund with a real yield, or move to a broker that defaults to paying you fairly. 2, understand that free trading was never free. The commission was the most transparent fee they charged. Everything that replaced it, payment for order flow, cash sweep spreads, margin rate markups, is deliberately designed to be invisible. Your job is to make it visible. 3, platform quality compounds. A slightly better interface, slightly faster customer service, slightly more flexible product access. These small edges add up over decades into hundreds of hours saved and thousands of dollars earned. Lazy investing built more fortune than crypto memes. The broker that makes lazy investing easiest is the one that wins.